Hello and welcome to episode 4 of Talking Central Banks podcast with me, Karan Mehrishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about US macros impacting Fed decisions from the perspectives of a global investor. Our guest tonight is Ritesh Jain, who is a seasoned trend watcher and macro investor, steering a global asset allocation fund under the Pine Tree macro umbrella. As the founder of Narizen, he pioneers a platform connecting NRIs or non-resident Indians with investment opportunities in India. Serving as an independent board member and strategic advisor to a leading wealth management firm, Ritesh's influence earned him a top 3 ranking in the world of economy and finance on LinkedIn in 2019. Fast forward to 24, Ritesh featured among the top 100 in finance in North America by Top 100 magazine. In his earlier role, he was a chief investment officer at a major asset management firm in India, involving and overseeing a substantial $8 billion in asset under management. Welcome to the show, Ritesh.
Thanks, Karan. Thanks, everyone.
So, Ritesh, long story short, what is your outlook of the US fiscal and monetary policies in the near term? And how does it impact your long-term overall assessment of the US economy?
So, US is running a fiscal policy which normally happens in wartime situations. You don't run a 7% fiscal deficit when the economy is humming along, you have 4.2%, unemployment kind of thing. So this is not a normal time. I could understand this, they're running this kind of fiscal deficit when they were getting out of COVID, but it seems they love the spending money too much.
Right.
Now, what happens is when you're running 7% fiscal deficit, next year you have to run more than that to create a delta. That is a year-over-year impact which we keep on talking about. So if last year you were running 6.5%, 7%, and this year also you're running 6.5%, 7%, without a growth in fiscal deficit alone, you will find that US economy is on the verge of a slowdown. I would just say a growth slowdown. I will not talk
Right.
about being in recession because a 7% fiscal deficit will not allow you to get into a recession. Since you are in a growth slowdown, you want the baton to be passed on to the monetary policy for the time being. Last couple of years, monetary policy was tight. They were happy being tight because fiscal policy was loose. Now, since the fiscal policy cannot expand further from here, they want monetary policy to be loose. So whatever you are hearing over the last couple of months majorly, the kind of pressure which is being put on Federal Reserve is for the simple purpose that they understand a growth slowdown is coming. They want to preempt that growth slowdown by giving one more boost to the economy, and this time through monetary authorities. So you find that, and this comes to the next important thing. Has monetary policy become an extended tool of the government? I think this normally happens in Latin America or it happens in third world country. I'm finding exactly the same kind of thing happening in US at this point of time. What will be the implications? That's a separate thing altogether. But to cut a long story short, we are entering a growth slowdown world, growth slowdown US, and we certainly need interest rate cut from US Fed for this growth to not go into recession, but to stabilize over here.
What about the inflation outlook, given the printing of money in the US, Ritesh? What are your views on that?
So since 1990, there have been, whenever the core inflation has been above 3%, they have cut rates only once in the history. So I have a 35-year-old data. Only one time they've done it. This time in the month of September, it looks like at 3% core inflation, almost at 3% core inflation, they'll be cutting the rates again.
Right.
And you are seeing this kind of inflation numbers. Just take into account, oil is a non-entity today, 60, 65. It's hardly there, there's hardly any
Yeah.
oil inflation. Residential construction is not up. Housing prices are not gone up. Residential construction is, employment is also, residential employment is also not there. In this kind of environment, when oil inflation is not there, residential construction has not picked up, your inflation is actually becoming stubborn. It should have collapsed by now. So I strongly believe that the new normal for inflation is not 2%. It is actually 3%. And I think Fed also understand that thing. That's why at Jackson Hole, they had to, they had to come around that thing, come around their own talk a couple of months back by saying, we will not take into account tariff inflation because it is transitory in nature. It has not even come till now, tariff inflation. So the whole point is that look at the US-centric world, not from a 2% inflation perspective, but from a 3% inflation perspective.
But isn't that a global phenomena right now, Ritesh? Because even the RBI has brought forward its reimagining of the FIT framework. So even they are probably thinking, I'm not really sure what they're thinking, but even probably they're thinking that inflation target could be higher than the 4% threshold that they have been talking about all these years.
Absolutely. And you have to look at it only from the point of debt to GDP across the world. In a world where Western world has a debt to GDP above 110, 120%, the GDP growth rate itself is 200 to 300 basis points below the interest rate itself, you get into a debt trap. So you have to target higher inflation to get out of the debt trap. 2009 to 2022, the world was of real GDP targeting. The new world is about nominal GDP targeting. And nominal GDP targeting does not mean that there is a set for real GDP. It is a combination of real GDP plus inflation. So the only way to get out of this debt trap when the GDP itself is not there and the inflation is becoming sticky, start floating a trial balloon in public. Make them accept a new inflation target. Target nominal GDP instead of real GDP. The only reason is just too much debt.
But the forward guidance will go for a toss, Ritesh, if that happens. I mean, if the nominal threshold goes up, it's going to be mayhem in the financial markets.
It might not be a mayhem. It's just that they're conditioning us. They're conditioning the financial market. Look, yesterday you had the first time a Fed governor was fired. Did you see any problem in the market? Weren't we conditioned for the last 15, 20 days on an everyday basis that a Fed governor could be fired? We were conditioned. Look at the S&P 500 today. The only thing which will happen in this kind of world is 30-year will go unanchored. The long bond yield will get unanchored. The term premium starts building in the longer duration maturity papers. Shorter end can be controlled by the central bank. There is absolutely no doubt in my mind. Look at the 10-year, 20-year and 30-year is where you will say the, mayhem. The mayhem will happen over there. And for the mayhem not to happen, US Treasury will do some kind of work or some kind of, change in the duration of borrowing, where they can just reduce the duration of their borrowing by not borrowing in that particular duration.
So shorter duration basket could probably become larger.
That happens in Latin America. That will happen in Western world. US is nothing but an Argentina. Actually, look at the shorter duration used to be 15, 20%. Now shorter duration has gone to 47%. They're borrowing everything at short end. Why would a first world country borrow at short end so much money? Think about it. Because there's just too much premium, term premium, for them to borrow money at the long term. The buyers of those bonds are asking just too much premium. Why would you buy? Why would you do it? You're a first world country. Has it ever happened before? No, it has not happened in my living memory.
Very interesting stuff, Ritesh. But Ritesh, getting back to Jackson Hole, how do you read Jerome Powell's recent speech? And do you think any shift in US monetary policy uh, might be in store? I mean, obviously, the market is expecting rate cuts after the speech, and I think the financial markets are reacting to that. But what impact can the emerging markets expect from this speech at Jackson Hole?
So US monetary policy was all about a combination of both employment and inflation. They will balance both the things. It has historically been like that. In Jackson
Right.
Hole, they very clearly said it is the employment is the imperative for them. Last last month, employment data which came was weak. And we know that
Mm,
last couple of years data could also be weak with the kind of sound bites which we are getting. So they want to run, after Jackson Hole, one thing became clear to my mind, they want to run the economy hot. They agree to US current administration that we need to run the economy hot. If
right.
you need to run the economy hot, you need to overlook the inflation, which you can say is transitory in nature, and you can focus only on employment generation.
Okay.
In that kind of environment, if you allow inflation to run hot, then dollar is a casualty.
Hmm.
Because your real interest rates, you are saying my real interest. So dollar is here in spite of such a high real interest rate in US. Look at the
Mm,
10-year and inflation. In spite of that, US dollar is not getting bid. If the difference between inflation and interest rate comes down further, dollar is the casualty. And if dollar is the casualty and the weak dollar is in the future, then the money moves
mm,
USD into other assets.
okay. But I mean, in some sense, I was talking to another guest recently, and he was also saying that the correlation between gold and US dollar, the inverse relationship that we often talk
Yes.
about, uh, it's not really apparent right now. And it seems that both the US dollar and gold are moving the same direction.
Yep.
So, any cues in your opinion
So
from here?
there is an inverse correlation between US real interest rate and gold.
Mm,
Why? If the real interest rates are positive, why would you own gold? Gold ultimately it's a 0% coupon, right?
right.
If I go by exactly by the same chart which existed before 2022, today gold price should have been less than $1,000 with that kind of positive real rates. What happened
Right.
in 2022 was G7 countries confiscated or sanctioned Russia's FX reserves.
Hmm.
At that, so FX reserves are something which are, these are things which nobody has touched till now. It is Russia's money in USD lying with any bank in US. As soon as they were sanctioned, that day gold got a new lease of life, and the real interest rate, the inverse correlation to real interest rates in US interest rates was broken. That day, gold became as good or better than US treasuries for investing. And gold has now entered the system as neutral monetary asset, simply because we cannot now depend upon, or we are all afraid, all the central bankers across the world are afraid of parking their entire FX surpluses in USD. Think about it, the spat which is going on between India and US. Is it unthinkable that tomorrow US can sanction one more FX reserves of any other country? Well, they've just done it 3 years back. It's a trust
Yeah.
which is broken. The day the trust was broken, that day the chart broke of
Mm,
a correlation between US real interest rate and gold. Consider gold as a new monetary asset, which has
mm.
no counterparty risk. If you are investing in USD, that USD, you have a counterparty risk.
So, is that the reason why uh, countries like Turkey, uh, China even India now, are increasing their gold holdings as part of their net foreign assets, both from the perspective of banking and issuing segments, to diversify their portfolios.
Actually, that is
And
not the only reason.
yeah.
The reason is one more. Over the last 2 years, China has been buying Saudi oil by bypassing USD.
Mhm.
So they buy oil from Saudi Arabia, and obviously nobody will accept yuan, right? Why would you accept yuan?
Right.
So Saudis can take that yuan, go to Shanghai Metal Exchange, convert it into gold, and fly that gold back home. So you're not only
Mhm.
using it to diversify, you are using it to actually bypass USD in international transactions also.
And gold basically can be owned by anybody. It doesn't have a nationality, so it
And
can
no
be bought from any
counterparty
country.
risk. No
Exactly,
counterparty risk.
exactly, exactly. Very interesting. Uh, why, Ritesh, is there a difference of opinion between the US government and US Treasury on cutting interest rates? And you can maybe touch upon the gold aspect to your answer.
So US debt to GDP is touched 130%. Not that this administration has done it. It was given to
Hmm.
them.
Right.
130% is debt to GDP. They want to reduce the debt. Okay. They want to reduce the debt.
Hmm.
And one more thing has happened is their interest paid on their debt has touched more than $1 trillion, which is more than they spend on their defense. Think about that. If your current coupon on your 37 trillion debt is 4.5%, you pay X% as interest on that debt. And if the interest rates are cut by 100 basis point, and over the next 4 or 5 years, your interest on that 37 or $40 trillion goes down by another 100 basis point from 4.5 to 3.5%. I'm just giving an example.
Hmm.
Can you see how big difference it will create? So that's why they are saying keep the inflation on side, which is you talk about as your mandate. Help us. We are already trying to do everything by having tariff revenue, make in US. Even if you want to make in US, you need lower interest rates. You need lower interest rates so that dollar can also fall and you can reindustrialize. Everything is falling in place for US except the Fed, which was standing its ground and saying, no, I will stand on my own. What I've done for the last 30 years, I will continue to do that only. But in this brave new world, where there's so much debt that US can just collapse under the weight of the debt, they want Fed to be an extended arm of the US government and do what the US government wants.
Mhm.
So let's say tomorrow they cut the rates, because now in Jackson Hole, it looks like they're coming around to that view. They cut the rates and long bond goes unhinged, because the term premium market will start asking, oh, you've cut the rates. Inflation has not come down and you've cut the rates. So let's say long bond yield starts moving up. At that point of time, US Treasury can actually effectively monetize the gold on its book of 8,144 ounces of gold, which is at $40, $42 to, currently at 3,400, make it, revalue it at $3,400. You get $900 billion from Federal Reserve Bank into your bank account, and you can use that $900 billion to shave off the long-term borrowing. US has lot many tools, but every tool works if Fed falls into the place, if Fed policy falls into the place.
And Ritesh, I mean, I think that there could be one other reason, and that is growth maximization, as you were also alluding to earlier. So if you cut rates, then you are propelling GDP growth, and you have to grow at a number higher than the inflation number in order to repay that debt effectively. So I think they're under pressure to cut rates because they need to maximize growth. And I think you were saying in the beginning that inflation is no longer their concern. And I think that is why they are so much focused on growth, because without growth, repayment of debt becomes difficult.
Yeah, they have to outgrow this debt.
Exactly.
And in that kind of environment, this world is all about nominal GDP targeting. Fed is still on the old path of, before Jackson Hole, was on the old path of real GDP targeting.
Yeah.
But they are also coming around to the view of nominal GDP targeting. The time is now where central bankers will become an extended arm of the government. Look, we don't react too much to what central bankers are doing because we believe the power has, after COVID, has gone into the hand of the government. Government is deciding winners and losers. Government just wants now central bank to be an extended arm, do what they wanted to do. Having said that, I think the sweet spot of inflation is 3 to 4% in US. Once the inflation starts moving beyond 4%, it leads to even equity returns going negative. But we are far away from there. What the government wants, the US Treasury wants is forget the 2%, accept the 3% as the new normal. So for the next few months, the coast is clear. You could see rate cuts, and plus you have a new Fed chairman. And these days, the people who've been appointed into the power are actually very amenable to the current administration.
So given this background, Ritesh, as a global investor, in your opinion, has the Fed's credibility gone down with time?
So the Fed credibility has gone down, I would say, especially after Jackson Hole. But even before that, over the last 5 years, they've done massive mistakes. They've done hiking when the cycle was ending. They've cut the rates dramatically when the inflation was starting. So let's say in November 2024, just before the election, you cut the rates by 50 basis points. What was the justification of you cutting the rates? In fact, the US vice president is on record to saying you wanted to help the Biden administration. That's why you cut the rates by 50 basis points. So over a period of time, it has got tarnished because they're always looking at rear view mirror and driving the car.
Speaking of which, Ritesh, perspectives on rates and currency valuations, uh, why is there so much emphasis on tariffs at this point in time?
My view, and I've written a Substack article on that, I believe, and President Trump is on record, he wants to cut the income tax rates to zero for anybody earning till $200,000. We have done some work, and I'm not remembering the number now. If they can get X amount of revenues from tariff, then he will be able to cut the rates, income tax rates in US for up to $200,000 to zero. Think about the world is moving from direct taxation to indirect taxation. In the US, they want it through tariff. A person making $100,000, $80,000 has zero income tax, but he pays through tariff. In India, a person making 12 lakh rupees has zero tax, but if he decides to consume, he pays through GST. US is not doing anything differently than what India has done over the last 5 years. Shift from direct to indirect taxes. And indirect taxes are a function of if you consume, you pay for indirect tax. If you invest, you don't pay for indirect tax.
Yep.
And he will be known as, knowing that grandeur, he is like that, he will be known as the greatest president in the history of the United States if he is able to cut the income taxes to zero for anybody earning 200,000, which is 86% of all the taxpayers.
Given the fact that $90,000 is a per capita income in the US, I think that number is pretty justified.
And coincidentally, even in India, 84% or 85% of taxpayers are below 12 lakhs. You cut it down to zero.
Yeah. Yeah. And reap the taxes through indirect taxes, as you pointed out. Yeah, you basically dovetail consumption.
Absolutely. You consume, you pay. You invest, you don't pay.
But A lot of us want to ask this burning question, Ritesh. Why is the US burning bridges with emerging markets, including allies like India?
So
Even
they
though
are
India
burning.
does not likes to call itself an ally, but still.
So it is a responsibility of the reserve currency to share its GDP with the rest of the world, run
Yeah,
current account deficit, so that its currency can be accumulated by other countries and can be used for international transactions.
right.
US, in fact, offshored its entire manufacturing to China, although China should not have become a part of WTO. It was not a market economy. It was the US corporate greed at that point of time which prevailed under President Clinton.
Yeah.
Over the last 20 years, the public opinion has shifted. There's 77% of people in US actually prefers unionization, actually prefer union. The voter base of President Trump is these people. Corporate profit of the percentage of GDP has gone through the roof, and salaries and wages as a percentage of GDP has collapsed completely. So you know what has happened? It has become an ultra-capitalistic economy. The pendulum is now swinging on the other side. And this pendulum says that whatever has happened in the world in the last 30, 40 years will be reversed. Because US wants its reserve, because its citizens wants it reversed. Because the people who had voted President Trump into the power wants it reversed. There are more than 100,000 fentanyl related death in United States. Obviously, there are states and states which have gone, look like a third world country because jobs have got outsourced. Now they want their jobs back. When you want your jobs back, and on top of that thing, you do not even want to police the world. You want to reindustrialize again. So you are not picking a fight with everybody. Everybody has to understand. US is no more willing to share its GDP with you. If you are an export-based economy, you will get hit. You should have made it a consumption-based economy or a
Mm.
more balanced economy. That's why Europe is in trouble. That's why Japan is in trouble. That's why South Korea is in trouble. That's why India is not in trouble. India is a balanced economy.
Mm.
So we are in a world where US is saying it's acting like a mafia don. It's acting like somebody who wants to have an equal relationship with you. It's saying, don't depend upon me. If you want to depend upon me, pay for it. A
To
reserve
access my
currency will
market.
not. A reserve currency will not say that thing. So US is effectively telling all of us it doesn't want to be the reserve currency of the world anymore. There are no more advantages of US remaining as the reserve currency of the world anymore.
And that is the consensus, Ritesh, among investors like you when
So
you
I
talk to
would
your friends?
say stable coins, I would wait for stable coins implementation.
Mm.
But the Genius Act told me, and the way gold is behaving is telling me that this process has just started. It will not reverse. They knew about that the trust is getting broken when they were picking a fight with each and every ally. As you said, India is not even an ally. The ally are Japanese and the NATO countries. They are also being treated equally badly as India.
So since you touched upon the reserve currency topic, Ritesh, so the US government wanting to narrow down its trade deficit will have an adverse effect on the availability of US dollar in the global market. As you know, a country needs to maintain a trade deficit to ensure enough supply of a currency in the system. And this phenomenon is popularly known as the Triffin's paradox. So how is the Fed going to ensure sufficient USD uh, s- uh, in the system, in your opinion? Because I think at this point in time, as you mentioned, I think both importers and financial markets are not really trusting the USD as a reserve currency. Uh, so do you think the belief under Triffin paradox will take a hit?
Uh, so there is an easy way out. You start using swap lines. US as it is has swap lines with a lot of countries, all the allies, it has a swap lines.
Mm.
Now, Stable coins, can stable coins be used for that? I do not know. I'm still working on that thing, understanding my theory. But I think we are entering into a world where one is a US centric world and one is a non-US centric world. Anybody who's a part of US centric world, agrees to US conditions, help US reindustrialize, will become a part of that coterie and will always be held via swap lines. So if Japan has a serious problem and Japan has to sell US bonds to fund its own currency, okay, then US Fed can give them swap lines not to sell those bonds. So US Fed swap lines will be weaponized now.
I think the bigger question, Ritesh, I think if you ask US policymakers, they'll tell you that the swap lines are not available to uh, most emerging markets because of lack of current account convertibility.
Hmm.
Sorry, capital account convertibility. So obviously, countries like India will not go
Yes,
on that road. So how would the US justify a swap line with India, for example?
I don't know. You are absolutely right about it. I would not be able to answer that question with the kind of clarity which you
Mm,
expect from me on this, because it is still a evolving situation for me. I'm thinking, can stable coins take away some of this pressure on USD?
right.
Uh, but still, there is nothing which I've seen on the stable coins as such. They believe that $3 trillion of demand can be shifted from banking system to funding US Treasury through stable coins, which will allow for the availability of stable coins to be there with all these countries, whoever exports to US.
Mm,
So it is still in the air. But otherwise, I understand that offshore dollar market, which is the euro dollar market, is 10 times the size of US monetary base.
right.
So the Triffin dilemma is there simply because of the rising trade deficit which has happened in the past and which is going to narrow down in the coming years. So the availability of USD will come down. But you're thinking from rest of the world, even from US own perspective, they want USD to be down to industrialize.
Right.
Higher USD means rest of the world will just sell US assets to
Mm,
fund for those losses. So even they want
right.
it lower. How it
Mm.
will happen, I'm still, in the process of making my thought process on that.
So next question, Ritesh, is on the big beautiful bill. But if the US also goes in the direction of China, that is, if it develops its industrial base and it becomes a net exporter, just like today's China or Germany, even that would basically nullify the effects of the Triffin paradox, right? I mean, then the supply of the US dollar will not be sufficient for it to remain a reserve currency.
Exactly.
And
Yeah.
yeah,
Yeah. So that's exactly what I said. US doesn't want to share its GDP with anybody. US is
yes,
saying,
I mean, that's
consider
the,
me as one of my countries and I'm your competitor now. I will
yes, no
compete
longer
with
a
you.
consumer.
Correct. I'm no longer
Mm,
consumer. I will produce everything within for me to consume. If you want access to my market, give me capital so that I can produce in this country. What Japanese have given them or South Koreans have given them, a blank
mhm.
check. And what they are doing by buying out stake in the companies without paying for that stake, it was never heard
Yeah.
of in a capitalistic economy. If you would have told me that a country is doing that thing, then I would always say it is China,
Mm,
which is exactly what US is doing,
mm,
buying out stakes in the company. So think about
right,
US who's very clearly stating his intentions. I don't want to fight a Ukraine war, but if you guys want to fight it, I'm happy to sell arms and ammunitions to you. Fight. Then it's going to South Korea. I don't want a shipbuilding. Your ships are not expected over here. We will charge for those ships. But the biggest shipbuilders are being invited to US. Make in, make in US, no those ships. The same thing with Arizona chip factory. Normally, a reserve currency does not do any of this thing. A reserve currency's biggest export is actually its currency.
exactly.
But now US is saying no more
Mm.
because it's a
I
matter
think
of national security.
I mean, the US dollar is America's superpower.
Yeah.
There is no denying that fact. And I think they're playing with that. at this point in time.
Or maybe they
By the way,
understand that
yeah,
it has outlived its, usefulness.
utility. Hmm. Yeah. Printing money at will is a is a great asset for any government
For
actually
any
across the
government.
world. Yeah. You can basically print money at will and you can issue as much debt as you can because there are buyers standing in lines to acquire that debt.
Or even if they are
So
not, you can push them, you can arm twist them. It happens in Latin
exactly.
America.
Yeah. Speaking of which, Ritesh, how do you see the Big Beautiful Bill Act having significant impact on the fiscal balance of the American government right now?
So Big Beautiful Bill has done a very interesting thing. We know it is the President Trump's second term is the last term. What he's done is spend now, and all the cuts to spending will start after 2028. So he's pushed the problem to the next person, the next president. For the next 2, 3 years, expect that their deficits will not come down. But after that, they will have to reduce their deficits. So you are fronting the spending. And spending is always, always good for the economy
Right.
if you are able to control the interest rates.
Do you think the US economy is less vulnerable to a debt crisis at this time, Ritesh? I think all prior reserve currencies that ultimately uh, lost their reserve status was primarily because of debt crisis, given that currency and debt must be effective stores of wealth, or else they
Hmm.
are
Hmm.
devalued and abandoned by the users. What is your view pertaining to the US dollar?
It's a controlled demolition. They also understand that thing. Everybody has read the history. All all empires end because of too much debt and never-ending wars. You can see them getting out of wars, not being drawn into the wars, which they have been done it for the last 30 years. They want to be out of those wars. It's a controlled demolition of gold. That's why they are allowing gold to go up. Earlier, gold never used to go up during US trading time. It was actually hit lower. Now gold is being allowed to go up. They want the store. The same thing China is doing. China currency is not depreciated against uh, USD, but it is massively depreciating against gold.
Mhm.
USD is also depreciating against gold. They're allowing their currency to depreciate against gold. They want their currency to become cheap and to keep interest rate lower. They
Mm.
have done this thing between 1945 to 52. They kept the bond yields, allow the inflation to run hotter, industrial production surged, the debt to GDP came down from 130 to 70% in a matter of 7, 8 years.
And why are they uh, acquiring crypto assets? So I think, uh, not sure which department, but I think the US has a substantial holding of crypto assets at this point in time.
So
Uh,
those crypto assets are only seized assets.
okay,
They are on record to say they will not buy it. But if it is seizure, all other countries, so a lot of other countries, including European countries, whatever they seized, they sold. Germany sold everything. US is saying, as a policy, whatever we seize, we are not going to sell it.
okay. So could it be used as a hedge for, I mean, against the dollar depreciation?
I think it's a very small amount as of now.
Okay.
If they start buying Bitcoin by issuing bonds, at that point of time, this question becomes superbly relevant actually at that point of time. You are
Mhm.
converting your USD bonds into Bitcoin. They've not done it. There are companies, treasuries, which are doing that thing, borrowing and investing in Bitcoin. But US government is very clearly on record till now that they will not be doing any of that stuff.
It could be the catalyst for the next US debt crisis, uh, if it happens, and how the US economy is moving towards that in your assessment, Ritesh?
So the next debt crisis happens if the inflation becomes unanchored and Fed
Hmm.
is forced to raise the rates. The country
Right.
which is 70% of consumption economy and which gets massive amount of revenues only from cap gains will start having double negative impact. If inflation starts rising beyond a normal level where Fed is forced to raise the rates and equity markets get negative impact. So you'll have a both two negative impact at the same point of time, rising interest rate and falling equity markets. Falling equity markets take away your tax revenue. Rising interest rates increases your debt burden. And that is a great recipe for a debt trap. At that point of time, they'll not be left with anything. I would say today there is a very mild case of stagflation. But you tell me
Hmm.
that if inflation is going to remain above 4% or start going above 4%, then I would say that I would start getting concerned about US debt trap or whatever you're talking about, debt collapse.
Hmm. So it is a possibility, in your opinion, that
Yes,
we might be looking at a debt crisis in the US.
yes.
Probably not in the same magnitude as the GFC, or probably in a
No,
smaller
actually it will
proportion.
be bigger, no, because the country is
Hmm.
too much indebted. And in 2008, they were not indebted. They could
Hmm.
easily print and get out of it. This time, if they print on
Hmm.
and get out of this, try to get out, it's already, see, the inflation in 2008-10, it even came down to 0%.
Hmm.
And at $60 on oil, your inflation is not below 3%. So your starting point of inflation itself is 3% today. If inflation starts, so there is a study which was done. The sweetest spot of equity markets, where equity markets can
Hmm.
continue to rise, is below 4% on inflation. Once the inflation starts moving beyond 4%, it start impacting the P multiples.
Hmm.
So I
Okay.
would say between 3 and 4, I'm okay. But if somewhere I can see that now the inflation is moving beyond 4%, then at that point of time, all the hell will break loose.
No, I think the long-term targets, at least that is what the FOMC is expecting, is to come down to around 3%. But I mean, forward expectations always go haywire. So
Yeah,
especially in times like these, with so much volatility and geopolitical risk, and this tariff burden also on US households, I think it could be a problem that they probably are not prepared to handle from the
I
central
would,
banking perspective.
yes, that is possible but on the other side, I would say the US Treasury Secretary is a very experienced person.
Mm,
So they have people who are quite experienced. But when you see something new happening in front of you, at that point of time, we do not know how they will behave.
mm,
But I would not want such a weak central bank because you would have lost your credibility if inflation starts moving towards 4%.
right, agreed. So finally, as a global investor, Ritesh, who is more important uh, in your opinion, the Fed or the US Treasury,
It's a US
when
Treasury.
thinking about your investment decisions?
It's a US Treasury.
Okay.
US, if it was US Fed, it is real GDP. If it is
Mm,
about US Treasury, it is about nominal GDP. I'm investing, or my investments are all based only about nominal GDP. Next few years, it is all about focus on nominal GDP. Any assets which benefits out of nominal GDP is a part of portfolio.
very interesting. Well, that's all I have for today, Ritesh. Thank you very much for joining us all the way from Canada. Thank you once again for the time.
Thanks, Karan. Thanks, everybody.